Hello, dear student. Today we are going to understand accountancy chapter depreciation. In this chapter, we are going to understand the meaning of depreciation, the methods of depreciations. Now, let's start the chapter. Firstly, we are going to understand the meaning of depreciation. Depreciation is the reduction in the value of asset due to its wear and tear or with effluence of time or due to obsolescence. That means when there is a fall in the value of fixed assets due to the use, this term is known as depreciation. Depreciation causes our wear and tear. Efflux of time means passage of time and the obsolescence. That means outdated technology. It reduces the value of the asset. Now, the characteristics of depreciation. Depreciation is fall in the value of tangible fixed assets. Yes, for example, machinery. By the use of machinery in making products, the value decline every year. This term is known as depreciation. It is a process of allocating cost of assets over its expected useful of life. The useful life means the asset is useful for making the products. It is an expense which does not involve cash. It is only a reducing balance. No cash payment is made for the reduction. Now we have to understand three major important terms: depreciation, amortization, and depletion. Depreciation is the reduction, amortization is also the reduction, depletion is also reduction, but depreciation in case of tangible fixed assets, amortization in case of intangible fixed assets, depletion in case of reduction in natural resources. Now, the objectives or need for providing depreciation. To determine correct profit and loss, we need to calculate the depreciation or the expense. To show true profit, to show true profit and loss, we have to maintain a profit and loss account. Then we calculate the depreciation balance. On the debit side, we have to record the depreciation balance. To determine cost of production, depreciation is also calculated because it is included in it. Like according to this example, raw material is 100 rupees, suppose labor is 200 and the machine is used rupees 100. So the cost which involve the raw material, labor as well as the use of machine, then the cost of production is calculated. So with the help of depreciation we can understand that we calculate the cost of production. Now we understand the depreciable amount can be calculated by using this formula: cost of assets minus estimated residual value. The estimated residual value means the scrap value at the end of using machine. Now the methods of recording: by two methods it can be recorded. Method 1, that is depreciation is charged to asset account, and method 2, depreciation charged to provision for depreciation. These entries will be passed. Firstly, the meaning of first transaction is assets purchased in business. Assets come, that means it is debited, and the asset goes out, that means bank account is credited. And then we charge the depreciation. Depreciation is an expense according to nominal rule. We debit that item. And the depreciation balance is transferred to profit and loss account. Then third entry will be passed. Now, the methods of depreciation are the most important topic of this chapter. Straight line method and the written down value method. Straight line method can be known as original cost method, fund installment method, or fixed percentage method. In this method, depreciation is calculated on original cost and the amount of depreciation is remains same in the ahead years. The merits of this method is it is a simple method and every year the amount of depreciation is same. The demerit of this method is sometimes the book value of the assets become nil. The two formula used in this method are amount of depreciation, rate of depreciation. Amount of depreciation is calculated cost minus scrap value upon useful life. Rate of depreciation is not given, then you can use the formula amount depreciation upon cost into 100. It is a very simple method. Second is written down value method. In this method, the depreciation is charged every year on book value and the amount of depreciation continuously falls. According to this method, depreciation amount is same. According to this method, depreciation amount continuously fall. Now we take one example to understand the concept of depreciation according to SLM method, that is straight line method or fixed percentage method, and WDV method, our second method, that is reducing balance method. According to SLM method, we understand the depreciation value remains same in the upcoming years. According to WDV method, the depreciation value continuously falls. Now we take this example. Here the value of asset is 1 lakh rupees. In first year we use this machine, in second year we also use this machine, in third year we use this machine. The asset cost is 1 lakh. The rate of depreciation is 10%. That means every year you use the machine, 10% it reduced its cost. Then we can calculate the amount of depreciation by using the formula cost into percentage. That means 10,000 reduction can be faced by the business in the terms of depreciation every year. This method is simple. At the end, that is 10th year, the depreciation value is 10,000 but the total depreciation is 1 lakh. That means depreciation is equals to asset cost, then the value of the asset become nil. Now we understand this example in WDV method. In WDV method, we also take that the cost of asset is 1 lakh and the rate of depreciation is 10%. First year we use this machine, second year we use this machine, third year we use this machine. But the name of WDV is reducing balance method. That means it is calculated on balance. Suppose first year is 1 lakh value, then we calculate 10%, that is 10,000. The book value is 1 lakh minus 10,000, that is 90k. This is the book value. On the book value, we calculate the depreciation for the second year. 90,000 into 10%, that is 9,000. As you can see that the first year depreciation value is 10,000. The second year the depreciation value is 9,000. And the third year the depreciation value will be 8,100. So the depreciation we see it continuously falls as we process ahead, and in this case the value never become zero of assets.